Hello, everyone. Welcome today's session. I've got a different microphone today. Just want to make sure that you can hear me. If you could just type in to the question panel there, if you can hear me okay, that would be fantastic. It looks like everything is good to go as far as seeing the screen and hearing the audio. As I watch for that, let's jump right in here and get underway with current market conditions. And right in the heat of the summer right now, where we just are getting light volume and not a lot of activity that's happening. And we're continuing to see this overall melting up where we're just getting markets that the breadth is not fantastic, but we're just continuing to move higher. News is not that bad. We're continuing to see kind of moderate inflation numbers coming in. Interest rate numbers are still high, and so that's still going to be a factor going forward as we talk about a little bit about the macro perspective. And really, those three things are still driving the narrative, and that is interest rates, which is tied to inflation and the Federal Reserve, and then we also have AI, which is really driving the technology space and driving a lot of that interest that's happening in AI right now, and efficiencies and a lot of different talking points that are happening. With regard to the future of AI and what the possibilities are, and there's still a lot of excitement there, and I think that's kind of driving that perspective of everyone's going to do better. I think at some point we're going to run into a scenario where we start to really see who's going to benefit and how, and a lot of those stocks are currently working as far as the infrastructure. A lot of infrastructure happening still with NVIDIA and chips and data centers and energy companies, and a lot of those companies that are benefiting currently as infrastructure is being built out. I think a lot of the apps, a lot of the usage, and a lot of the Chat GPT type scenarios. How do we integrate AI into how do businesses integrate it? And how do consumers integrate it? I think that's still that's going to be currently working and embed in society over the next year or two or three or even longer. But Microsoft's doing a good job with their Copilot, which competes with ChatGPT, and a lot of companies are dealing with auto dialers and even automated voices for customer service and a lot of different things there as well. Just interesting, but it's such in its infancy. It's certainly driving a lot of the perspective going forward. Let's take a look here at the current market conditions. We're still bullish in a bull market. Rank is 25.78, sitting at the upper end of this range right here. And this number right here is as high as we've been. And I mentioned that almost every single session, just because it is as high as it's been. So over the markets, they are as high as they've been. So we've got to be aware and be prepared for either a slowdown or a pause or a kind of a crawl higher or sideways or some retracement first. Lots of scenarios can happen, even significant more upside. The more upside we get without some retracement and some counter trend, the more painful the counter trend is going to be when it starts to get here. So we just want to be smart and be aware that these conditions and markets going straight up, they just don't last forever. So we want to be allocating our capital in ways that we're managing our risk at the upper end of this trend. And we'll talk a little bit more about that. We'll go over a few buy entry processes as well, just as a refresher. We're also seeing these, when we're looking at these setups for the direction alerts. Whoa. Something froze there on me for a minute. But when we're looking at these setups where we have momentum, or rather sentiment at the top, momentum and breadth. Early in these trends, we're looking more at information like this, or we're seeing really strong breadth, really strong momentum, and sentiment is actually catching up. So as we start to see that, we know that we're in the latter parts of the trend as well, because everybody's already on board. There's nobody that's fearful, but price activity is starting to diminish a little bit. We're seeing weakness in price trend, and then we're also seeing weakness in participation of this trend. These are just topping patterns. We typically don't see breadth as strong, or they're just weakening patterns. They could start to recover. That's one thing we could see. We could see a lot of those stocks that have not participated in this uptrend start to participate. We'll look at that buy sell ratio here in just a minute as well. And so moving from these levels is going to be tougher with significant upside versus some kind of a pause or counter trend. Let me actually dip down here and we'll look at this breadth. That hasn't changed. Neither has sentiment. Those two have really been the same for months. The buy sell ratio is seeing a little bit of a coming back together a little bit. We've got 0.74. We still got really bears in control of this overall uptrend, and which is interesting that there's more stocks in downtrends than there are uptrends, but the S&P and NASDAQ have really been driving the way higher. Dow, not quite as much. It hasn't participated in this rally quite as much because it is a lot of these, value type names for the most part. Not tech, not growth, maybe other than Apple and Microsoft, which are moving things higher as well. So it's going to be an interesting few weeks to see. We also have, this is a presidential year. Presidential years historically are positive years. So, and if things are leaning a little bit more Trump side of things, then, the market tends to be a little bit more small government, more, free business, market driven, and versus the Democrat side of things, which typically is towards larger government, more social programs, very, very generally speaking, obviously, but in terms of that perspective, lower taxes, things like that typically come with the Republican side. The whole circus that's lining up though, so it'll be interesting to see how that pans out over the next few months. Typically though, markets tend to rally in those years. Let's jump over to NASDAQ. Let's take a quick look here. You can see NASDAQ continue to do well. If we go out to that 1 year time frame, and S&P 500 is really similar to this pattern also. The 1 year time frame just really bullish. We've had a really fantastic 18 months off of these lows, really off of this low right here to move up. And then we had a little bit of a pause right there, and that happens in these uptrends. You get a retracement, things will move back, continue that overall uptrend. And that's the 2 year time frame. This is the 6 year time frame. S&P 500. The Dow though, not quite as strong. It's an interesting price pattern to see really what is leading and moving the market. There's more and more discussion out there online about this and whether it's a good thing or it's a bad thing. And ultimately, it is what it is. But what we do know is we know that there are pockets of stocks that are doing really well, and there's a whole lot that aren't. So ultimately, for what that spells, stock market will typically be, it's a forward-looking beast. So it's always trying to discount the future, meaning it's looking out 6 months, 8 months, 9 months, even 12 months, and saying, what do we think is going to happen? Then we're going to start placing our bets now, and so it's typically a leading indicator of the economy, and so neither are really giving real negative signals right here. Market's nothing really negative, other than there's just not a lot of participation, but there's enough participation to continue moving higher, and we're seeing some of that starting to happen. And as far as economic numbers, really nothing significant that has spooked the market, at least at this point. So we're kind of in this middle of the road right here. The biggest issue still is just going to be that interest rate game. The bond yield curve still inverted. This short end of this yield curve has got to come back down. This long end could stay here, but the short end of that yield curve has got to come back down in order to have more sustainable economic growth. The shorter, typically for short-term borrowing, we need shorter interest rates. And part of this inflation issue has been the fact that there's a lot of money chasing not very fewer goods, and so as the cost of borrowing is more expensive on the short end of this yield curve, then it hampers borrowing and it slows down more money going into the money system, and that at a very generally is kind of what the Fed is trying to do in terms of slowing inflation, is slowing the money supply, and that happens with interest rates. Is one of the only levers that they have to be able to pull, and it typically has worked pretty well. I know that we are a spending borrowing society, and We like to tap into our home equity lines. We like to borrow money for cars. We like to borrow money for everything. And so put money on credit cards, and that's just more and more expensive. So the point is we should, at least the Fed's point is we've got to slow down that that ability to spend, utilizing debt. And that is, I know I did see another number about, credit card debts are at all-time highs, and that's not abnormal. That's just how Americans live. So, but this has got to correct itself, and typically happens with a stock market correction. Let's jump over here to the sectors. I think I touched on that early on. So let's jump over to a couple of setups. I wanted to review two things today. Number one is the allocation. Remember that depending on the market conditions are going to depend on how you're allocated, and essentially what percentage do I want in stocks, what percentage do I want in cash. So right now I'm running this portfolio at about 75% cash. We just dipped up a little bit, more than 25%, and we have about 15, 16 holdings, and that is the risk profile that I'm managing right now, as far as I just don't want to have that much exposure. And the ones that we do have, we're taking profits a little bit sooner, tightening stop losses a little bit sooner. It's just about the management of the process versus saying, oh yeah, everything looks amazing, let's just jump all in. And because what is this? Let me go to this chart, even this 20-year chart. We're at the upper end of this range. We've had a long run, about this distance here and here, here and here. Those two alone are very long uptrends without a counter trend. And you can see some of these trickled along a little bit longer, but for the most part, each of these rallies somewhere between 18 months and 2 years. And so we're coming into that 2-year time frame on this rally. That doesn't necessarily mean that things are going to reverse, or we're going to get a bear market, or it's going to get really ugly. You're going to obviously have lots of people that are saying that for various reasons. That's what creates a market. But what it does mean is we just want to be aware of the probability of continuation to the upside, and just manage that risk. And everybody's a little bit different, so you can manage that a little bit higher in terms of percentage allocation towards stocks, and how to be able to manage that trading plan. So that's kind of your 30,000 foot view on economic conditions, at least as far as I see them, and the information that I'm utilizing, which is not a lot. We don't need a lot of information. We need a handful of things. The bond market, the stock market tell pretty good stories, and well, those are really the stories that we're focused on, as well as the commodities market as well, in looking at oil, looking at gold, maybe where some money is moving to, in and out of. And then other technologies like blockchain and cryptocurrency. We don't hear much about those recently, and those technologies are still around, they're still working, and there are a handful of names that are participating there. NVIDIA back here in this new uptrend, back into the buy zone. Not with fervor. It's still just kind of a quiet period of time. Most of this, more than likely, is the time of year coming into the out of the 4th of July week, and it's just kind of nice to tune out and turn off the computer and our brains for a little bit. But we're going to start to see that coming awake here in the next 2 or 3 weeks, as market conditions and people get back to business here. But then we've also got the election coming up. That's going to add some interest to this market. I wanted to go through. So in terms of buying into these market conditions, there are two different adjustments inside your trading plan that you can utilize within the TradersPro system. And that is, number one, when you're looking for opportunities, when should I be in the market? When should I be buying stocks? And we know that this top-down approach, we know we're in an uptrend. We want to be trading stocks in bull markets. We want these are opportunities that we should be buying. Okay, but now what we're running into is we're at the upper end of this range. So then what? Do we still buy stocks? Do we, how much, how little? Do we go start to look for bearish opportunities? Okay, so those are going to be different scenarios based on the aggressiveness that you want to focus on. Number one is, it's like, yes, this is still bull market uptrend. You could go the next more conservative approach and say, I'm not going to buy stocks as long as the buy-sell ratio is less than 1, which it's not right now. So that puts you out of the market entirely for pretty large swaths of time throughout the year. Not large, but 6-8 weeks where there may be times where you're not trading. Or in this case, right now, this portfolio methodology that I'm utilizing is continually buying something each day. Okay, it doesn't necessarily mean the allocation is typically a little bit smaller, closer to that 2% versus that 2.5%, and then we can take gains a little bit sooner into some of the strength. So as we've got some gains, we've got one that's coming up, Dutch Brothers. It's pulled back just a little bit, but it's approaching that 20% gain range. That's an area where you can start to say, I'm going to take a little bit off the table. I'm going to sell into the strength, just because market conditions may allow for that right now, but they may not allow for really big runs on some of these stocks, just because there's only a handful of stocks that the market is really interested in right here. So let's jump over and take a look at, I think it was Western Digital. So let's say, okay, we're looking at Western Digital. It's pre-market. We want to buy this stock. It's got a new buy signal. Now we're going to determine our risk on a trade like this. So as we're going in, and some of the criteria would be, okay, let's assume that today hasn't happened yet, or it's still morning, and we're setting up our trade. We've got a buy signal here, meaning that it's just moved back up into this bullish trend zone. It's now trending again, and it is happening on larger volume. Okay, and we're above the 236, which is the momentum zone, and we want to try and focus on stocks they found some support. They're rallying, they're in this uptrend, maybe they consolidate inside of this zone, inside of this range, and then it breaks out and continues higher. Okay, that's what we want to see. So in this case, this has the majority of criteria that we'd be looking for an entry. Now what we've got to do is we've got to decide, how many shares do I buy? So if I'm just saying, oh, I like this stock and it's $78, I'm going to buy $1,000 worth. Is that your plan? Is that to what ends is that $1,000 a part of your bigger portfolio? Is it all your money? Is it 1%, or is it 2%, or is it 10%? Okay, the part of the trading plan is deciding how much risk you're taking of your tradable assets. This doesn't mean, okay, I have a net worth of whatever, and I'm going to trade 2% of my net worth. No, I'm trading a certain percentage of in equities. And I may even decide, of my $100,000 that I have in my brokerage account, I'm only going to commit 10,000 or 20,000 to this method, and I'm going to trade 2% of that money. So decide what pot of money you're allocating your 2% of, and then decide if 2% is too little, or if you want to bump that up a little bit. So in terms of the methodology, it's always the same. Plus or minus maybe different times that you're focusing on, but what does change is the amount of money that you're committing to the trade. So for example, I would go in and I'd say, I'm going to use this $100,000 number, and I'm going to say, how many shares can I buy for $100,000 or to be inside of my 2% range at $78.80? Let me start out with 50 and see. Okay, that's 3.78. Now I'm watching two places here. I'm watching down here, and I'm watching right here. These are the numbers that are going to change on as we're updating. Okay, so we want this number down here, portfolio at risk, to be 2%. So I've got to change this down to 30. That's 2.7. Let's go to 25. 25 is 1.8, so I could go up a little bit, and let's go 27. So 27 shares at the current price. Now the current price is as of now. It wouldn't have been as of this morning, but just so we're following this process. But pre-market is when I prefer to do the analysis and then set up the trade, so that you're an hour before market open, and you can kind of see if you're going to get any kind of movement that day, any gaps or anything, and then you're setting this up based on those numbers going into the trading day. You can also obviously do that analysis in the evening after markets have closed, but it's just a quick process to go look through the stocks. Are there stocks that are meeting those criteria, that have a new buy signal, 236 or higher? You'd also want your rank to be 90 or higher. Those are just some general default type of settings, just to make the number of stocks that we're focused on a lot less. And so now, obviously, this says trade percentage at risk is 100%. Why is that the case? It's because I haven't got a stop loss entered in here. So I want to see this number first. I want to know that of my 100,000, this number, which is 2%, this $2,000 number is the total trade at risk because I'm not using the stop. Obviously, we know that, you know, Western Digital is not going to drop to zero, and it's not going to drop, you know, 50%. It could drop 50% if something crazy happens. We've seen that, but this is really the worst case scenario. And I want to know, is the worst case scenario okay with me on this stock? And in this case, yes, it is. And I don't want the worst case scenario, but I want to know what type of risk I'm taking. And you know, in this case, 2%. So now I want to add a stop loss in because I don't want to have this number at risk. Obviously, I need to set a number. Now, typically, an easy and good way is either the low of the most recent hold signal, which would either be here, the low of the core of hold signals, or the 236. Okay, and if both become pretty close, we can start out with this 236. I'd prefer a little bit wider stop, okay, if possible, but because we want to allow for plenty of volatility. But if we said this number right here, 73.86, let's just round that down and go 73.85. If I go 73.80, or excuse me, 73.75, go 73.75. Now, this number right here, this means now I have $136 at risk, which is 0.13 of my entire trading account, and my trade at risk is 6%. So if the stock drops from where it is right now down to $74, wait, what did I put? No, $73.75, okay, then I'm going to lose this amount, okay? Or I'm risking that amount for the opportunity to get into this stock at the right time, in the right market conditions, and it's in, and I've got this set up. I can't do much more than that, okay? Once we've kind of utilized the edge that we're following, and that is we're looking for these high-ranked stocks, we're looking for one that's got a new buy signal, meaning it's entered back into this bullish trend zone, and we've got our stop loss, okay? And from there, it's the market's in control of either making the money, but our job is to say what does that potential risk cost me? Okay, what is that going to cost me? And think of it as a cost, a potential business cost. It's a potential business expense, because we're making an investment, and that investment comes with risk. And in this case, that risk is I've decided if it doesn't move higher from here, I'm out. I'm going to take that risk, which is going to be $136 in anticipation for more upside, 20, 30, 40, 50%. Okay, that's a good reward to risk at this point in time. Hope you can see that drawing. It's kind of faded out a little bit, but that is essentially the setup, and that's the process. And I've got to say, yep, okay, I'm good with everything on this page. If this is $10,000, then I'm going to be using, you know, 3 shares, and this is going to be $13 or $25. Okay, we don't need to be risking hundreds of dollars if our account size is a little bit smaller. Obviously, the reward on the other side is going to grow a little bit slower as well. But in this case, when we're managing a portfolio of stocks and we're doing it relatively conservatively so that we're utilizing some diversification across individual stocks, then this is one of the ways to do it. You can obviously say, okay, I'm going to trade a whole lot more than 2%. I want 10%, okay, on each holding. And if I did that, we got rid of this stop loss, and I said I want to do 10%. Let's go up to 100 shares. That's 7%. 120. That's 9. 130. Okay, so 135 is about 10%. So that's 10,000. Now, if I applied my same stop loss at $73.75, now I have at risk $600 on this trade, and I've got 10% of my allocation towards that. So that's a little, I'm turning the risk dial up, okay? I didn't change anything except for this. I'm not changing my stop loss, I'm not changing my analysis, I'm not changing my process, but I want to take more risk. Well, what do? I've got to buy more shares. I've got to take a bigger position, okay? And that essentially is now instead of $130 at risk, I'm willing to risk $600 because I've got a lot larger position size. Okay, so if that works inside of the trading plan, again, the risk is that I get stopped out of this and I lose 600. With a smaller position size, I'm losing 130. So I could lose 6 times on a trade and lose the same amount of money I'm willing to risk on this one larger trade. Okay, so the risk adjustment is happening with the number of shares, number one, and the stop loss, number two. I could say I want a big position, but I don't want that much risk. Well, what do I have to do now? I have to change my stop loss. So instead of a stop loss way down here, maybe I've got to go all the way to this low right here and go 76.50. Well, if I went 76.50 on the stop loss instead of 73.75, 76.50, well, look what that does now. Okay, it changed this risk all the way down. Now I'm at $300. I'm not quite back to the $136 with 2% at risk, but I've tightened. I've got a larger position. I've got a tight stop loss. And so now I'm not allowing for much volatility at all. Okay. So the bigger the position, the tighter the stop, the more accurate. You got to be right. It's got to move quickly, and you're not allowing for the amount of volatility. That for me personally, I don't like to do that because I want to give the stock enough space to have some volatility to do its natural thing. Stocks go up and down, and to be right on the exact bar within, and get it right instantly and have a super tight stop. I don't like. For me, that just adds additional stress to the trade. Not to say that that's not impossible, but for the longer term, slower trading type methodologies, then I want a little bit. I just want less risk to be able to just to stay in the game longer. The one trade that you set up with a big risk like this, it's inevitable. It ends up being the one that busts you in the chops, and it's never fun. So but if it's in the trading plan and your account size allows for that, then you've got a structure, you've got a reason, you've got a method to the madness, and you know exactly what you're doing and why, instead of saying, oh, I'm just going to put 10,000 in this, and I don't know where I'm going to put a stop. I'm not even going to put a stop loss in because I just think it's going to go higher. Well, that's just a mistake. You're asking for trouble because, and then it turns into a $10,000 trade with no stop into a $4,000 or $5,000 loss that turns into a horrendous investment that you're going to have to hold on to forever. Okay, so managing the risk and the stop loss in the beginning is always going to prevent you from holding on to a piece of crap that is costing more and more and more and more the longer you hold on to it. Okay, and then also taking a little bit smaller stabs at it, especially if you're newer to this. Make sure that the risk is really small. There's no reason to take large risk. There's always a stock that's around the corner. There's always something. Market conditions are always changing, and those are not, some market years are fantastic, and some times of the market are fantastic. Others are what they are. Right now, we're at the top of the market. We've got 100 stocks controlling the entire market, and the rest of them are moving up and then maybe retrace and have some volatility there as well. So I think you get my drift when it comes to what we're talking about. I hope so, because I'm repeating it over and over and over and over again, because that is the method. That's the system that we're following. And the risk management part of it, I don't care what other system that you may use, you still have to know these two things: the number of shares, the risk you're taking, and the stop loss. Okay? Or if you're not using a stop, you're okay with the position size being this big. So if I've got a position size, I'm managing my risk with position size, which is the number of shares, and the stop loss location. Okay, these are the two pieces that I can control of the risk management, and I want to know that every single time going in. I promise it's very refreshing to know what your plan is. We can't always predict the outcome. In fact, we can never predict the outcome, but we know that over time, the idea of stocks are to continually move higher. Great stocks move higher faster. Very profitable stocks move very fast. Speculative stocks move fast based on a new technology or a new idea. Okay, but we have to make sure that we're managing risk as we're analyzing a lot of those trades. And then once we've got that system and we're following it, then we can come in and we know what we're looking for. It's like, oh, okay, Vital Farms, I like it. I like the setup, confirmation bar, increased volume. Okay, maybe I'll take a trade on that. Well, what do I do here? I come in, I set my risk, number of shares. I can just start off with 100 and see where that's at. In this case, that's a little big. 50, 40, there's 45 shares. So 45 puts me at 2%. I may want to stop all the way down here at 40. There's my risk, 260 based on that, based on this stock, based on that setup. Okay, so whatever stock you're looking through and looking for, and again, this is only one. There's a couple of different methodologies that you can utilize inside TradersPro, but this for me is the most consistent, and it allows you to get into the trends at different times. We can't always get into the trend at the exact early location because we miss other opportunities. But what we want to focus on are stocks that have this look and continue to trend higher. And when can we get into some of those? That's what this new buy tab is focused on, is some of these stocks that are just turning the corner, or they're up in this uptrend zone and they're starting, or they're advancing. Let me just refresh that. They're advancing those overall trends. And so like this one, even though this is a high ranked stock, it's because it's had this much of a move, but I still wouldn't be interested. Why? Because it's not up here in the momentum zone yet. It doesn't mean it won't get there, but the higher probability trades are going to have they're already working. They're already moving in the up direction. This has resistance, 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 fib level, fib level, fib level. Okay, that's got a lot of overhead resistance. I would skip past that one. Even this one, I'd probably skip past this one. Now, NVIDIA, here we go. This is what we want to see. We want to see something that's up here. Looking, here's our buy signal. Okay, well, what did we do back here? This is where we got into that last NVIDIA trade. Okay, and you know, so far we took some gains here. Here we've got a trailing stop on the rest of the position. If we were looking to re-enter into NVIDIA into a new trade, now's the time. Okay, this is the location. It's early in the trend. Remember what we're looking for. We want stocks that are trending. I like to go to this 2-year view and get rid of volume, because look how much yellow you see. Yellow is flat, yellow is flat, yellow is flat, yellow is flat. Look at the green. Okay, this is where we want to trade. This is the kind of setups that we want. We want it right here. Now the question is, does NVIDIA have the gas in the tank to give us one of those and more green to the upside? Who knows? Okay, that's why we take a trade, and we don't know the futures. We take it based on the setup and the criteria, and then we get what we get. Okay, again, market conditions are the upper end of the range. Obviously, NVIDIA 2 years, it's had a huge run up, but we've talked about the rationale with the PE of 75 and a PE all the way back here. The PE ratio was 50, 60. Let's see the last time. Right here it was 90. Okay, so when NVIDIA was at $20 a share, it had a PE of 90. Right now it's $130 a share and has a PE of 75. So it's actually cheaper now than it was back here in terms of the price to the earnings correspondence. Okay, that ratio, and companies have to earn money. Okay, they just have to earn money. The faster they earn money, the faster the stock is going to go. It's just the way that it works, and the anticipation of profits or the anticipation of future earnings can also drive the stock. That's why a stock with no earnings, the stock price can go up, because participants that are buying that stock believe that in the future they will be profitable and they want to buy in now, and that it creates a marketplace for those scenarios. I'm going to end on that note. I sure appreciate everyone's time and effort, and we'll see you next time. Have a great day today. Bye now.